welcome friends once again to the NPTEL MOOC module on international trade theory and empirics. We are here on the 10th week of its discussion. We have so far discussed about balance of payment and exchange rate determination, and in that particular chapters we have understood how the flows of transaction from one country to another country defines the stability of the country in terms of their balance of payment and and its reflection on the exchange rate. Now, to discuss these two aspects, I think we have already taken the understanding like some theories of exchange rate determination, how interest rate is determined, then law of one price, commodity arbitrage. Then we also discuss about absolute purchasing power parity, relative purchasing parity, that is real exchange rate, and then also nominal exchange rate. We also talked about different types of exchange rate market, okay, forward, spot, then future market, etc. Now, the second half that is left here for our discussion is we are discussing more or less this side of the linkages due to international trade and due to exchange rate flows. So, this week is dedicated to explain the role of monetary policy. So, purely the balance of payment fluctuations and or the exchange rate changes are explained by monetary as a complete monetary phenomenon, okay. Especially since the floating rates began in the year 1973, international financial flows are now larger than the trade flows. That has actually shifted the focus of monetary theory of exchange rate, okay. So, so role of money, the currencies and their flows have been dominating in the international trade discussion than that of only trade flows. Besides that, we have also discussed theories which view the exchange rate as a purely financial phenomenon, and that tend to explain exchange rate volatility and disequilibria in the short run. But in the long run there are other interpretations. We will take it forward to the next week. But some of the implications of the short run phenomena of monetary policy and its implication exchange rate volatility is also being discussed. So, the monetary approach to the balance of payment is an explanation of the overall balance of payments. It explains the changes in balance of payment in terms of the demand for and supply of money. The demand for money because of transactions and the supply of money because of the need for transactions. So, in both the cases role of money is important, and that is where the monetary approach is focused on. And according to this approach, quote and unquote, a balance of payments deficit that occurs when we know that imports exceeds exports, and that balance of payment deficit is always and everywhere a monetary phenomenon. Therefore, it can only be corrected by monetary measures as mentioned by this particular approach. Here I am taking the discussion for some experiences of rupee dollar exchange rate over the time. Par value, peg rate we have already discussed in our previous week, and market determined rate. So, till which time we have par value, which time pegged exchange rate, from which time onwards India's rupee dollar transaction has been following the market rates. Now, especially in 91-92 onwards, India opened off its economy and majorly it is determined by the market. Earlier, especially from 73 onwards when floating exchange rate starts, we talk about the market peg rate or basket rate. Okay. Now, I think the rupee dollar exchange rate is a rising trend. That means the value of rupee is consistently depreciating, okay, and against dollar. So, then what is that monetary approach? Overall, the monetary approach to the balance of payment views the balance of payments as a monetary phenomenon. Okay. So, that means money really plays the crucial role in the long run as both a disturbance and as an adjustment. So, disturbances as well as for adjustment aspects, money really plays the crucial role. Now, to explain the monetary theory and its implications on the dynamics in the exchange rate, we need to go through certain assumptions which have been proposed by the monetarist. This approach is based on the following assumptions, that is, first one is the law of one price, which holds for identical goods and in different countries after allowing transportation cost. Okay. Then the second point is also important to explain, because they assume a perfect substitution in consumption in both product and capital markets, which ensures one price for each commodity and a single interest rate across countries. Okay. So, it is not like in the country there will be multiple pricing structure for each commodity, it has to be one price, then only monetary approach could be explained to find out the volatility of the exchange rate. Then the next assumption is the level of output of a country is assumed as exogenously determined. Okay. So, output in reality it has endogeneity, but the assumption by the monetarist theory is that the output has to be exogenously determined. Okay. All countries are assumed to be fully employed, where wage price flexibility fixes output at full employment. Now, first part of this assumption is that there must be full employment, and if any errors are there or mismatch is there, the flexibility between wage and price would actually fix the output at the full employment level. Price, by reducing wage rate, can employ more persons, and that would be reflected in pricing structure also. We will see all those things in our discussion. Some other assumptions are like, we are referring to other assumptions. All right. Now, other assumptions are such as that under fixed exchange rates, the sterilization of currency flows is not possible on account of law of one price globally. Okay. So, the demand for money is a stock demand, and is a stable function of income, prices and interest rate. Otherwise, it is very difficult to define. Then other assumptions are such as supply of money is a multiple of monetary base, which includes domestic credit and the country's foreign exchange rate. Okay. So, monetary base is defined by the domestic credit, that is the credit released from the monetary system of that is RBI and the country's foreign exchange reserve. So, we can define it through C plus reserve, if we can define as R. Okay. So, the demand for nominal money balances is a positive function of nominal income. So, demand for money balances is simply a function of its nominal income. Okay. So, now what is that theory that needs to be discussed in simple terms? So, given all those assumptions, the monetary approach can be expressed in the form of the following relationship between the demand for and the supply of money. So, the monetary approach largely discusses about the demand for money through its demand, demand is through demand for money, and they say that demand for money is a stable function of income, price and interest rate. This is what we have assumed already. So, money demand we noted at MD, okay, otherwise in short we can write down MD is a function of Y, that is income of the country, okay, then the price, then the interest rate. Okay. So, this is what the equation 1 we have already highlighted. Similarly, the supply of money is a multiple of monetary base, multiple of basically the money multiplier, whatever is being supplied or credit is there. If credit gets multiplied due to different forms of channelization of the money, it has its own velocity. Therefore, the money supply will be multiple times of its credit and reserves. Okay. So, M is the multiplier required to understand the total money supply in the country. Now, so money supply is equal to how it is defined, the D stands for domestic money, that is domestic credit, R stands for reserves, foreign exchange reserves. All right. So, this is first equation, this is second equation. Then we come to the equilibrium demand for and money that determines the interest rate and the equilibrium level of output in an economy. Now, by equalizing these two, we equate that M D equal to MS. So, M D is equal to D plus R. So, what is this D plus R? Then that is basically equivalent to MS, that is money supply. Okay. Now, so a balance of payments deficit or surplus is represented by changes in the country's exchange rate reserves. Okay. Because exchange rate reserves also determine the net demand for money and demand on the supply of money, okay, or the currency. So, the delta or the change in reserves is nothing but the change in money demand minus the change in the domestic credit availability. So, if you take delta here, so M D is equal to, in short we have written that M D is equal to D plus R. So, delta R we can write it down as delta M D delta D minus delta D. So, D here stands for the domestic credit, okay. R the delta reserve stands for the foreign exchange reserves. All right. So, delta M D is demand for money. So, demand for money minus the demand for money minus the availability of domestic credit calls for the change in the exchange rate in the foreign exchange reserves. Okay. So, here, so delta R we are denoting with B, okay, let it be B. So, where B represents the balance of payment, basically the net demand, this is what is called B, because the demand for money minus the availability of total credit within the country is all about the balance of payment. If total availability and that of MD there are mismatch, then accordingly we find some forms of disturbance in the balance of payment. Now, so B represents the balance of payment which is equal to the difference between the change in the demand for money and the change in the domestic credit. Okay. So, a balance of payments deficits means a negative B as we already mentioned, and which reduces the reserves. When when we have a negative D, that means that means the total, the change in the D is higher than that of that of the MD. Okay. So, so that reduces the reserves of the country. So, so a balance of payment deficit measures balance of payment deficit means a negative B, which reduces the R and the money supply. Okay. On the other hand, data supply refers to positive or B value, okay, and increases the value the total volume of R and the money supply accordingly. So, when B equal to 0, that means we have BOP equilibrium and no disequilibrium in the BOP. Now, there are two interpretations to refer so far as theory of monetary policy is concerned. One is called the monetary policy and its role under fixed exchange rate, and monetary policy and its principles under flexible exchange rate. Now, assuming that MD equal to MS, where there is no problem with balance of payment, so BOP is 0. Now, suppose the monetary authority increases domestic money supply, okay, with no change in the demand for money. So, demand for money is not rising, but money supply is decided to be increasing by the monetary authority, that is RBI of the country. So, which means that the money supply exceeds than that of money demand. That means when money demand is actually lower than that of money supply, it has impact on the balance of payment, because it has implication on inflation, it has implication on interest rate, okay. And so how the thing these work, people who have larger cash balances increase the purchases to buy more foreign goods and securities, okay. These tends to raise their prices and increase imports of goods and foreign assets, okay. So, since we are demanding more of imports, more of foreign assets due to more of money balances, and that relative price of domestic commodities increases comparatively, that has also negative implication on the balance of payment. So, in a nutshell, what we wanted to mention that these kind of changes lead to increase in expenditure on both current and capital accounts in BOP, thereby creating a BOP deficit. Okay. So, so far under fixed exchange rate, we mentioned that there will be a possibility of BOP deficit, but BOP deficit is there since it is a fixed current exchange rate regime. So, the exchange rate is not going to be reflected quickly, it takes a long time because of following a fixed exchange rate regime. This will eventually result into BOP deficit. Now, a balance of payment surplus in reverse results from excess stock of money demanded. If no money demand is there, that means there will be external demand for our product and export increases, therefore there will be surplus in the balance of payment. Now, the balance of payment surplus results from excess stock of money demanded that is not satisfied by domestic monetary authority. A balance of payment deficit results from excess in stock of money supplied that is not eliminated by monetary authorities. Okay. The surplus or deficit is temporary and self correcting in the long run. Okay. That this has to be marked correctly, that in the long run it will be self correcting, but in the short run, because of the pegged or fixed exchange rate regime, it is not going to be corrected, rather it will be shown in as a deficit or surplus in the balance of payment. Now, except for currency reserve nation, that is important to note that except currency reserve nation, those countries which have a huge currency reserve, okay, so I think this is not going to implicate them in the short run as well, because they can utilize their reserves. Except for currency reserve nation, the nation has no control over its money supply in the long run under fixed exchange rate system. All right. So, in case of currency reserve nation, they can able to tackle the problem in the short run as well as in the long run, but for other nations it might be difficult. Okay. When the money supply increases due to action taken by central bank, we refer to it as expansionary monetary policy, and if the central bank acts to reduce money supply, it is called contractionary monetary policy, as we all know. So, contractionary and expansionary we have already discussed. There are various instruments by which we can go for expansionary monetary policy and contractionary monetary policy. So, more on this you can read the money supply chapter. Since we are delivering issues on international trade, I am not clarifying all the details. Simply one is promoting money supply, another is facilitating money supply, another is contracting money supply. Okay, so now what we wanted to explain other implications through this page, that to maintain a fixed exchange rate, the monetary authority will have to sell foreign exchange reserves, okay, and buy domestic currency. Now, in order to maintain that exchange rate, if the exchange rate already is fixed, then I think it will be reflected in the balance of payment. Okay. So, thus the outflow of foreign exchange reserve means fall in the R, okay, and in domestic money supply. When the reserves, you can able to read from the chapters that money supply is also a function of the foreign exchange reserves. Okay. Foreign exchange reserves act as a monetary base for supplying currency or printing currency for the economy. So, this process will continue until MS is equalized with MD, money supply is equalized with money demand, and there will again be BOP equilibrium. On the other hand, if you go by a reverse change, if money supply is lesser than that of money demand, then at the current exchange rate there will be a BOP surplus. So, that means your money is demanded, that means your products are indirectly demanded, so there will be more exports. So, consequently people acquire the domestic currency by selling goods and securities to foreigners. This will also seek to acquire additional money balances by restricting their expenditure relatively to the income. Okay. Now, the monetary authority on its part will buy will buy excess of foreign currency in exchange of domestic currency, when that is the case of money supply is lesser than that of demand. Okay. Now, this will be inflow of there will be inflow of, then this will lead to inflow of more foreign exchange reserves and increase in domestic money supply. So, this process will continue until MS gets equalized with MD and BOP in equilibrium. So, these 4 points are relevant for equilibrium when this occurs, MS is lesser than that of MD. This aspect is just the reverse, where ultimately we discuss about the monetary equilibrium. Okay. Now, in case of expansionary monetary policy with a fixed exchange rate regime, what we wanted to say that suppose between two countries, that is United States and British, we are mentioning here that our exchange rate is defined as how many dollar a pound sterling can able to buy. So, it is the exchange rate of the United States, okay, against British pound. The horizontal line is drawn at a level called exchange rate at pegged at a level. Okay. Now from this one, if there is some mismatch between the money supply, okay, then in that case there will be disequilibrium. If the money supply, okay, money supply is exceeding demand or the reverse, then we can clarify there will be surplus, then there will be surplus highlighted, and there will be some forms of deficit highlighted corresponding to a different reserves, foreign exchange reserves. Okay. So, higher the foreign exchange reserves and higher the money supply, we have already discussed. Okay. So, if the money demand is equated with the money supply, then there will be no problem. When in that, when we have before the equilibrium condition, our money demand is higher than that of money supply. So, money demand is higher than that of money supply, that leads to surplus in the balance of payment. Okay. And in other case, it is reverse the case. In that case, we will approximate eventually to the equilibrium condition, and because of the adjustment. But if it is a fixed exchange rate regime and the country has enough foreign exchange reserves, then the country can able to manage with the rate. Otherwise, in the short run there will be disequilibrium in the balance of payment. Okay. Now, under flexible exchange rate, in short, I just wanted to clarify here that the balance of payment disequilibria are immediately corrected. Okay. But in case of fixed exchange rate, it is not immediately corrected. Okay. It takes a long term long time to correct by using the flow of foreign exchange reserves. Now, because of the flexibility in the exchange rates, balance of payment disequilibria are immediately corrected by automatic changes in the exchange rate without international flow of reserves. That is important. Okay. You can note this difference for any form of quiz. Okay. Now, the nation retains dominant control over its money supply and a monetary policy in case of flexible exchange rate regime. Now, adjustment occurs as a result of the change in domestic prices accompanying the change in the exchange rate. Okay. So, the adjustment is through its reflection in the domestic prices. So, accordingly there will be adjustment for the balance of payment. All right. Now, let us map the relationship between exchange rate and the money supply, relative money supply. So, here on the horizontal axis we take money supply of US as against money supply of UK, okay, and the exchange rate between between these two currencies. So, we are basically taking the exchange rate of US, okay, and the money supply of US as compared to the money supply of UK. In this comparison, we could see that when the money supply increases, okay, the exchange rate actually depreciates. That is, therefore, the diagram is upward sloping. It is actually increasing. That means, more dollar can be replaced with more dollar could be replaced with one additional unit of pound sterling. Okay. Now, now movement from A to B reflects that when money supply increases, the value of the dollar decreases, therefore, the exchange rate increases. So, exchange rate increases means we have said earlier that the value of exchange rate decreases, okay, or depreciates. All right. When the rate of exchange increases, the value of that exchange rate depreciates, and it settles at B. So, there occurs a direct relationship between these two. Now, here are some results from different books. Mainly I am referring Salvatore, Dominic Salvatore's book on international trade. So, accordingly I am citing it, the nominal and real exchange rate indices between the dollar and Deutschmark between 1973 to 2005, which says that which shows that over the time the nominal and real exchange rates between these two currencies are actually fluctuating, but the real value is higher than that of the nominal value. Okay. And it is almost following the same trend of rising and following, but on the average the rate is pegging nearby the 100 as the value. All right. Now, what are the criticism of the monetary theory? It needs discussion, because without that I think we are not completing our analysis. then we will discuss the criticism, then we will take a conclusion on that particular aspect. Now, the monetary approach to the balance of payments has been criticized on a number of counts. First of all, we need to emphasize the demand for money, as we have discussed that is not actually stable. Okay. If your demand for money is not stable, then it is difficult to define the money demand and its implications on balance of payment, equilibrium or disequilibrium. Then full employment assumption they have taken is not possible at all, and it is also criticized to the earlier economist as well, classical economist. And again monetarists also believe on full employment in the monetary market. And there are other aspects like one price law is not correct always. That is not always to be true, and to be considered to be true as one price is valid. Since demand is fluctuating every moment, it gets reflected on the price level as well. Similarly, there are market imperfections, sterilization is not possible, which is referred in monetary policy theory also. So, link between BOP and money supply is not not valid always. Then this monetary theory also neglects the short run implications, they refer mainly to the long run, and they neglect other important factors. They also neglect economic policy and its role on the exchange rate determination. So, what are the take on this particular monetary policy approach to the balance of payment and exchange rate? That despite this criticism, the monetary approach is realistic in that it takes into consideration both domestic money and foreign money. Okay, that is one important side of our discussion. Second aspect is that the emphasis is not on relative price changes, but on extent to which the demand for real money balances will be satisfied from internal sources through credit creation or from external sources through surplus or deficit in the balance of payments. Okay. That is another aspect has been emphasized. It's credit creation, external balance and other side are also important in this particular theory. So, a balance of payment deficit or surplus can be corrected through changes in the money policy, money supply, and their consequent effects on income and expenditure, or more generally on production and consumption of goods. So, therefore, this theory has also addressed the issues of correction, automatic correction of its deficit and balance payments. Okay. With this we have discussed the conclusion of this theory, and I think next class we will talk about some other dynamics through the monetary approach. Okay. Let me stop here. Thank you.